Alright, it's time for me to bring in Dhirenrda Kumar, the CEO of Value Research and our in-house mutual fund expert who joins us on the show every week. Dhirenrda, thank you for joining us on Investor's Guide. Let's get straight to our portfolio versus portfolio question. For 26-year-old Vaibhav writes in, his monthly income is 60,000 rupees. He has a home loan of 20 lakh rupees for which he pays an EMI of 18,000. Now, he lives in a rented apartment that costs him about 7,000 a month, and he invests 1,500 rupees in HDFC's Young Star Suvidha. He has another 1,500 rupees going into Kotak ULIPs. He's also invested in the ICICI Prudential Cashback, Jeevan Mitra, Jeevan Anand and Jeevan Saral policies from LIC. There is a few investments in mutual funds as well, and he wants to know if his choice of mutual funds is right. Now, before I get to the really long list of mutual funds he sends us, his insurance policies are causing me some concern. Now, Young Star Suvidha is a child plan, and Vaibhav hasn't mentioned being married or having children, which means that that's a completely missold ULIP. And he also seems to have a lot of other money going into ULIPs right now. Does that make sense, Dhirenrda? This looks like a very haphazardly put together portfolio. He has 6 different tax saver plans as well among his mutual funds. Does it need a complete overhaul?
I think it requires a complete overhaul, and I think he should just do a rethink about each and everything that is there in the portfolio in the first place. For example, the first thing to estimate is that, his 25,000 rupee of the 60,000 rupee he's earning every month is finding its way, either in, the EMI or paying the rent. So he's left with the residual amount is not enough. And depending on, what his monthly expenses are or what his budgeted expenses are, he needs a large term cover if he's married and if he has dependents. Assuming that 20 years of his annual earnings, which will translate into nearly something like 10 years of his annual earnings, so he needs a cover of about 70 lakh or 80 lakh rupees. Also, he needs slightly larger coverage if he has his EMI for that house, because that will also be that also has to be factored in his overall plan. Get a adequate mediclaim cover, and then I think the investment begins. Need to completely revamp it.
Right, looking at his mutual funds, we see 6 tax saver funds. There are a couple of thematic funds as well. There's natural resources from Reliance, and there's of course that infrastructure fund as well. Would you recommend he maybe looks at our aggressive portfolio at this point for his mutual fund needs?
I think so. I think even his mutual fund portfolio needs a complete revamp. And not only a revamp, he needs to just exit all his one-time investment, and if he has to build it all over again, and look at our growth portfolio or our aggressive growth portfolio given his time frame. Alright,
so our aggressive portfolio is on your screen right now, but we hope this helps. Remember, Dhirenrda told you that you need to relook at every investment that you're putting money into right now. A lot of them don't really suit your needs. Our aggressive portfolio is best suited for someone in your age group and someone with your level of risk appetite. So write back to us if you need any more help with making that shift from the investments that you have right now to the ones that you've been recommended. Alright, let's move on now to our hold or sell segment. Well, Chandan has written in, he's 38 years old, he has an investment horizon of 15 years for his 2 children. They're 6 and 8 years old respectively. He aims to save 1 crore rupees for their future, and he wants to know if the selection of mutual funds he has right now is the one that he really needs. Now, the first on his list is the ICICI Prudential Dynamic Fund. Then, is this the one that he should be investing in for the next 15 years?
Yes, this fund looks impressive over the past couple of years, and it is worth investing even now.
The next on his list is the Reliance Growth Fund. Should he continue investing in that one as well?
This was a promising fund. It has, it is not an extremely disappointing fund, but it is not as impressive as it used to be. It is a very average or a mediocre fund today. So he should keep an eye on this, and maybe at an appropriate time decide maybe allow few more months. But I'm hopeful that these Reliance funds they will actually participate in the rising market much better, and these funds really struggle, but they compensate as and when the market turns around. So allow it one more opportunity, but it's not an extraordinary fund anymore.
Alright, Sundaram Select Focus is the next on his list. Continue investing in this one as well?
Yes, this is a reasonably good mid-cap fund, and I'm assuming that Sundaram Select Focus mid-cap fund, because that's the more popular one, and he should continue investing in this.
Alright, HDFC Top 200 and HDFC Prudence, I'm going to take them together, A, because of the overlap. Secondly, because of how different they are from the first 3 funds that we named in his portfolio. This is a large cap fund and a balanced fund. First of all, do both of them make sense, and is this the investment he should continue making?
Both are good funds, but both of them don't make sense because one is a balanced fund. It's a very conservative, steady take on growth. The other one is a large cap fund, and both are impressive funds. But I think given his time frame, that's investing for 15 years, periodic investment, willingness to take assume risk, I think HDFC equity in place of these two will be a better bet. And maybe, it'll be a little more volatile, but it'll be worth it.
HDFC equity then to replace the two HDFC funds in your portfolio. And finally, Reliance Gold, Dhirendra. We've talked about the fact that having gold in your portfolio helps you hedge against inflation. But should he be putting it in the portfolio for his children as well? Does it make sense?
It has been very difficult to, resist the temptation not to have, of gold in past 2-3 years. Even, people used to put gold in their election manifestos to win elections. So I don't blame anyone, but it's there are different ways of looking at gold, and I look at gold purely as a speculative investment which has done well and might continue to do well if global uncertainty and all the anxiety prevails. But on a long-term basis, I don't think it is a great investment, more so at current prices, and of course it is unlikely to be stable at all. The way we have thought that it is a one-way, the only way it goes is up, and that too fairly rapidly. I don't think that's going to happen in future. It will be extremely turbulent. But still, in a portfolio like this, if you are thinking of your investment, 1,000 rupee investment in a gold fund for next 15 years, and you want to really ride the price of gold to be exchanged for gold after 15 years for your daughter wedding, I think then it's a very different kind of accumulation than investment.
So if he's looking then at accumulating for his daughter's wedding for the next 15 years, wouldn't he be better off in an ETF than the Reliance Gold Fund?
Yes, ETF will be a better option, and the differential could be half percent to 0.75%. But it will be inconvenient because going to open a demat account, go to a stockbroker, place your order, or open an online account. I think if you're looking at convenience, open-end fund for this price or for this price differential is not a very substantial disadvantage.
All right, Chandan, we hope that helps with your investments. Remember, you can write back to us if you need anything else. We have a quick question, Dhirenrda, that's coming from Ananya. She's 24 years old and she's been investing in mutual funds for the long term. But she's worried about her fund selection right now because it's given her negative returns. She wants to know where she can also invest her savings of 2 lakh rupees to get the maximum returns. Now, this is what she's been investing in: the ICICI Prudential Dynamic Fund, Birla Sun Life Dividend Yield Plus, HDFC Top 200 and HDFC Equity. So these are all very strong funds, especially for someone who's 24 and investing for the long term. But obviously, given the way the market has moved in the last 1 year, she's going to find those returns disappointing. But do you recommend a change right now, or should she continue with these investments?
She can well continue with this investment, and one can do without that investment in HDFC Top 200. And for somebody who is 24 getting started, I think one can assume higher risk with a slightly more little more aggressive with your small and mid cap fund allocation, which I find amiss here. But that apart, I think it's normal for everybody to get disappointed. If you started in 2011, if you started in 2010, but I think one should look at it as an opportunity. Maybe if you get a pay hike this year, increase your contribution to these SIPs proportionately. I think that's the right way of approaching it, and you will be reasonably rewarded. Just be through one market cycle, and I don't think you will need me to convince you. All
right, Ananya, there you have it. That's your advice. Now remember, it's not just you. All of the equity investors in this country right now are slightly disappointed with the returns they're seeing. But keep your SIPs going. When things turn around in the market, you'll be glad that you didn't stop your investments.